10 Investing Gems from Peter Lynch's 1-Up on Wall Street. Apart from Benjamin Graham's The Intelligent Investor, there is no better book to get started for beginners than Peter Lynch's 1-Up on Wall Street. The easygoing and simplistic stock-picking style discussed in this book brought Lynch great success in his profession as a fund manager at the U.S. mutual fund company, Fidelity. The best part about this book is that it's low on number crunching but high on anecdotal stories. Moreover, readers are given a clear picture on how to get off to a good start in the stock market. 1-Up on Wall Street offers insight into the mind of one of the greatest money managers of all times. Lynch helps you discover that he is a normal guy, like you and me, who thinks rationally, believes in doing his own independent research on companies, asks plenty of questions, and gets caught off guard by the market at times, just like anyone else. Anyone thinking about buying individual stocks must read this book before they ever make their first stock purchase. While there are numerous lessons that Lynch dispels through this book, here are my personal top 10 that really stand out. I have in fact benefited from incorporating each of these lessons in my personal investment philosophy. I hope these also add to your investment arsenal. So let's start right here. Peter Lynch's 10 Investing Gems.
Understand there's a 100% correlation with what happens to a company's earnings over several years and what happens to the stock. If the company, McDonald's, has done very well as a company,
right,
the stock has done very well. People worry about too much money supply, what's happened to the price of oil, who's the president, who's being nominated for the Supreme Court,
it's all
the ozone
earnings.
layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
Yeah, but what they will say to you, Peter, is that, as you know, and why am I telling you this, but anyway, it's fun to tell you this, they're telling you that these other things influence the amount of earnings of a particular company.
Yep.
If we're in a recession, people are not going to spend as much money on going to the movies
Absolutely.
or whatever they do.
Right.
And therefore, you got to pay attention to these other things because they impact on earnings.
They are very important, but you have no idea of knowing what they're going to do. Alan Greenspan's the head of the Federal Reserve.
Right.
He cannot predict interest rates.
Yes.
He'd be the first to
He
tell
can
you.
influence them, but he can't predict them.
He cannot predict what long-term interest rates are going to be 1 year from now, 2 years from now, 3 years from now. He's even surprised how low they are now. So how am I supposed to predict interest rates? How am I supposed to predict the economy? You certainly remember the recession of '82.
Yes.
1982, we had a 20% prime rate, 14% unemployment, 12% inflation. I don't remember anybody telling me in 1980 or 81 that was going to happen. Yeah. All of a sudden, we had the worst recession since the Depression. I didn't read about it in the paper. So it's crazy to think about these things.
There's also this idea of never invest in something you don't really know. Yes. that was part of it. That's why you went out on the road so much.
Right.
If I don't understand it, I don't want to.
Yeah. The key thing is when the stock goes from 10 to 6, if you understand what they do and you know they're financially solvent, you're fine. If you don't understand it, you can call the psychic hotline. But if you don't understand it, you're probably going to do the wrong thing. You know, if you understand exactly what they're doing, it's gone 10 to 6, you'll buy more. If you're confused to start with, you'll say, well, there must be something wrong there. And then you're out. And then a lot of times stocks are going to decline. I mean, some of my best stocks have gone from 18 to 8, then to sometimes to 40, and some have gone from 18 to 0. But at least I wasn't adding to it on the way to 0. A lot have gone to 0.
So if it's going down, you're not adding to it? I mean, sometimes you are.
If the fundamentals are getting better or the same.
Yeah.
But if they're deteriorating.
1. Understand the nature of the companies you own and the specific reasons for holding the stock. A lot of people buy stocks with the mentality, this stock is really going up. This reasoning of buying stocks has never worked in the long run. You might buy a stock that is going up in price, and you might make some money in the short run. But in the long run, this basis of buying stocks is going to suck you into a never-ending whirlpool of losses. A stock is just a share in a business. So it's important to understand what is the kind of business that you are getting into. And then you must have specific reasons to buy and hold the stock, again, reasons that have less to do with how the stock price is doing and more to do with how the business is doing.
The 500 largest companies in the 80s eliminated 3 million jobs. Eliminated 3 million, and we added 18 million. These 2.2 million businesses started. 2.2 million businesses started in the 80s. Now, some of them didn't make it.
Right.
But if on average they have 10 employees today, that's 22 million jobs. The only thing that creates wealth, the only thing that creates taxes to pay for all these wonderful things is jobs. There is something magic about jobs, and jobs come from companies starting.
That's what I was trying to say. Small companies create
Small
jobs, right?
create all the jobs.
Yeah, right.
So that's what I'm talking. This is not voodoo economics. This is the real thing. You have to encourage people to take some risk, to put their money out, and go start a business. It's a risky proposition.
2. Consider the size of a company if you expect it to profit from a specific product. You might say, I love Maggie. In fact, everyone loves Maggie. So Nestle must be a very good stock. Let me ask you. Great! But what if Maggie is just 1% of Nestle's total sales, and the products that contribute the remaining 99% aren't that great? Does Nestle still sound like a great investment just on the basis of one great product that contributes just 1% of its sales? Now what do you say? See, companies selling products or services that everyone loves or is talking about is worthy of considering as a potential investment. But as an investor, the greater task for you is to know how much of that great product or service means to the company. If it does not contribute meaningfully to the company's sales and profits, it can't be the core reason for buying that stock.
Quadruple in 6, they go up 8-fold in 9 years. That's how you get a huge stock in a decade. There's not a lot of these, but they're very powerful. And the best part is, you don't have to catch them just as they're taking off. The beauty of growth companies is you have plenty of time. If they're going to grow for 5, 10, 20, 30 years, you don't have to be there the first year or the second year. You could have bought Walmart 10 years after they went public and made 30 times your money. What makes a company grow earnings so quickly? Either it is a rapidly growing industry, or it's a rapidly growing company in a slow growth industry. Rapid revenue growth and rapid earnings growth are the hallmarks of a fast grower. You just can't buy any stock with hot earnings and hot sales. You have to check the balance sheet, make sure the company can keep growing.
Huge run. I mean, the market was 4,000 just 2.5 years ago.
Yeah.
And it ran up to 8,300 in August. And like any big rally, sometimes it backs off. I mean, it's healthy. In fact, I'd rather have gone down 1,000 points than gone to 12,000. If you look at Japan, Japan went from 5,000 to 15,000 on their Dow. And it was fairly priced at 15,000 on earnings and everything else. Then it went to 40,000. And that caused 7 years of inflated real estate, people overspending. And basically, they've been in a recession for 5 or 6 years because their market went up too high. The market goes too high, you're discounting earnings 7, 8, 10 years out.
3. Be suspicious of companies with growth rates of 50 to 100% a year. Growth for the sake of growth is the ideology of the cancer cell, goes a famous saying. In the same way, companies that are growing at rates of 50 to 100% annually must be looked at with suspicion. One reason for this is that such growth cannot continue for long, for reasons like higher competition that might want to take a pie of this growth opportunity. The second reason is that if such a company still wants to push for higher growth for a few more years, it might have to infuse more capital in the business. This could either mean stretching the balance sheet by taking on debt, or diluting equity by issuing new shares. Both these are bad omens for existing shareholders. What is more, 1 year of slowdown in growth can come as a shock to the stock market and might lead to a sharp fall in the stock price.
Diversification is a big mistake. I call it diversification. You buy this thing that might balance this other thing and they both go down. So I don't believe in diversification at all. I would own one stock. But what I do believe in is if I find 10 good stories, they're all equally attractive, I buy all 10. And I wait to see them unfold. It's like watching 10 poker games. 10 games of stud poker. You watch the cards turn over, story 3 gets better, story 6 slips, story 7 stays the same but it goes up 50%, so you sell 7 and buy 2. That's all I do. So if they're equally attractive, I buy all 10. Then gradually some story says, oh my God, this is getting better and better, and guess what? The stock just went down. So you keep watching 10 stories and magically, because of that rule of stocks going up and down a lot, then you load up. You really, take a big advantage.
4. Distrust diversifications, which usually turn out to be diversifications. Experience suggests that most diversifications, acquisitions of companies in the same area or a different one altogether, are done to satisfy the egos of promoters, and not for real business reasons. And most of the diversifications end up as diversifications. So watch out for companies that are blazing guns in this space. 5. People get incredibly valuable fundamental information from their jobs that may not reach the professionals for months or even years. Not many small investors appreciate this, but it is one of the best ways they can pick great stocks. If I'm a banker, I know what makes up a bank's balance sheet, and I also know which banks are worth banking upon as investments. Considering this, I would be a fool eyeing biotechnology or IT stocks, especially when I don't understand the ABCs of these industries, but just go by what my broker or friend advises me. Of course, I might enhance my circle of competence and learn about these industries, but my first hunting ground must be banking. 6. Separate all stock tips from the tipper, even if the tipper is very smart, very rich, and his or her last tip went up. Even if I love my fund manager for his stellar track record in managing my money, towing all his stock ideas without doing my own research would be fraught with extreme risks. The stock he is recommending on CNBC might form just 0.001% of his total portfolio. I might be so enamored by his story on the stock that I may buy it in bulk, and it forms around 10% of my small portfolio. Now, when this stock crashes, the fund manager would appear smart for taking a very small risk with it. I might lose my shirt. So the idea is to always do an independent research on a stock before you even think of buying it. 7. Invest in simple companies that appear dull, mundane, out of favor, and haven't caught the street. Such a company is rarely covered by stock analysts and bought by fund managers. So there is a great chance that the stock could be available at a great bargain. 8. Companies that have no debt can't go bankrupt. This is the most important lesson that you would remember or forget when it comes to identifying the right businesses for investment. Companies that borrow money to grow their businesses might appear good, because they are growing. But more often than not, such companies get so much intoxicated by the growth that they end up making a mess of their balance sheets, and in the process, destroying whatever shareholder wealth they created during growth years. Look at realty and construction companies, and you won't have to look anywhere else for such examples.
I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports, they buy a microwave oven, they do that. They ask people what's the best kind of radar range or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. And that's what we were being driven to, and it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict the interest rates. If anybody would predict the interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, there can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. But I'm trying to tell you it'd be very useful to know what the stock market is going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rate's going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that.
9. Devote at least an hour a week to investment research. Adding up your dividends and figuring your gains and losses doesn't count. I have been shouting this from the rooftop of Safel Night Shack all this time, but not many seem to hear. So now, let me tell you how much Peter Lynch believes in the power of independent investment research in the success of an investor. Lynch suggests that you must invest at least as much time and effort in choosing a new stock as you would in choosing a new refrigerator.
Say to yourself, I think this company's going to earn something in the future. If it's already discounting that, if it's selling at a huge multiple, you say it has to work, and then it's only going to stay even. So you have to say to yourself, if I'm right, how much am I going to make? If I'm wrong, how much am I going to lose? That's the risk-reward ratio. In Stock Shop, we talk about, if I'm right, I hope I'm going to double, triple my money. If I'm wrong, maybe I'll lose 30, 40%. That's a favorable ratio. You say, if I'm right, the stock's not going to go up. It's already discounting terrific things. If discounting terrific things are already in the stock, I don't want to own it. These public companies out there. Here's the company I really like. The fundamentals are terrific. Their earnings are doing well. Their competitors are doing poorly. I think this company's doing terrific. And all of a sudden, the stock might have gone from 40 to 30 because of this decline. That would say, wow, here's a chance to buy it. So you're trying to say some companies might have been overpriced at 60 and all they did was go to 50 and you say, big deal. So you're trying to find companies you liked anyway. Right now you liked them. And now they've had a haircut. That's what you would do. Not a stock that went from overpriced to fairly priced. Something that was fairly priced at the start of this exercise and then had a very, 5-for-4 sale.
10. When in doubt, tune in later. Now this is where the emotional part about investing comes into play. I have spent 10 days researching a stock, and thankfully on the 11th day, I find that it's a great business and even available at a good discount to the intrinsic value. So it seems like a perfect buy. Now, what in the world should stop me from buying this stock? Well, here are some questions that must stop me from buying that stock, call it XYZ, instantly. Am I biased towards XYZ just because I've spent 10 days researching it? Am I getting overconfident with my analysis? Am I impressed by just the company's recent performance? Do I like the stock just because it has fallen in price? Do I like it just because my friend advised it to me in the first place? If the answer to any of these questions makes me uncomfortable, it's an indication that I must sleep on the stock idea instead of buying the stock then. There have been numerous instances where I have waited weeks or even months before committing money to a stock idea I liked. As Peter Lynch says, the key organ for investing is the stomach, not the brain. The 15 to 20 days after I complete my analysis on a stock help me know whether my stomach is ready to digest the stock even when the mind answers in the affirmative.
Right 6 times out of 10. But if I'm right, I make a double or triple occasionally. It offsets the times you lose 30 or 40%. In fact, you could be right a third of the time as long as you have a lot of good results. So when you're short, you can only make 90%. When you're long, you can make 10-fold or 5-fold. So I think long is the way to be. Corporate profits have grown about 7 or 8% a year. That means they double, including dividends, about every 10 years, quadruple every 20, go up 8-fold every 40. That's the kind of numbers you're interested in. Betting a 10-year bond today is a little over 2%. So I think the stock market's the best place to be for the next 10, 20, 30 years. The next 2 years, no idea. I've never known what the next 2 years are going to bring.
I take a coin out and flip it. I have no idea what the next 1,000 points is going to be. The next 6,000 points is going to be up. The next 14,000 points is going to be up. The next 20,000 points is going to be up.
But you don't know what the next 1,000 is going to be. It
Nobody
could be down,
does.
could be up.
Nobody does. And it's futile to try and guess it. Corporate profits will be a lot higher 10 years from now. They'll be a lot higher 20 years from now. That's what you could rely on. Microsoft didn't exist 20 years ago. Staples didn't exist 20 years ago. Federal Express didn't exist 20 years ago. New companies will come along. That's what makes stocks
didn't exist 20 years ago.
That's what makes Amgen has 2 $1 billion drugs. They didn't exist 20 years ago. New companies have come along. That's what makes this country work.
What do you say? If you have read One Up on Wall Street, which are the other key lessons from Lynch you learned from this book? Please share in the comments section below.